Welcome to the Deep Dive, where we take that fire hose of information, all the articles, research, proprietary notes, and really distill it down to the essential insights you need to know.
And today, we are strapping in for, I think, what is arguably one of the most complex and, frankly, fascinating business transformations happening right now.
The Walt Disney Company, ticker symbol DIS.
It really is the ultimate case study. And this isn't just about, Mickey Mouse and Marvel anymore. This is a century-old icon at a profound inflection point.
A real crossroads.
For sure. The sources we have, these are comprehensive financial and strategic assessments from late fiscal year 2025. They paint a picture of a massive, difficult, but absolutely necessary strategic transformation.
And we're talking about everything here. A $60 billion park expansion, the brutal streaming wars, and of course, the huge question mark of CEO succession. All happening at once.
All at the same time. It's a high-wire act.
Okay, so let's unpack this. Our mission today is not just to look at the quarterly numbers or the latest box office returns. We are putting on the glasses of a long-term, value-oriented investor.
More in Buffett lens.
Exactly. We need to go past the headlines and really understand the quality of this business, the durability of its competitive moat, and whether the current management is allocating capital in a way that truly creates long-term value for shareholders.
That framework is absolutely essential because the core narrative here is this abrupt, almost painful shift from the growth at any cost philosophy.
That was the big streaming push, right?
Exactly. The initial Disney Plus build-out. And they've moved from that to a strict, almost draconian mandate for profitability and capital efficiency. It's what analysts are all calling the Iger-Thesa era. It's all about optimizing the assets they've already bought.
So we'll be using those three qualitative filters Buffett always talks about: business simplicity, moat durability, and management quality. But first, let's just ground ourselves. Give us the snapshot, the paradox of where Disney sits right now in late 2025.
Well, the initial snapshot shows this profound market paradox. We've seen significant, even stunning operational improvements inside the business. Fundamentally, it's getting healthier.
Okay.
Yet the Disney stock actually underperformed the S&P 500 in the trailing 12 months. It's basically been stagnant while the broader market has been growing pretty robustly.
Wait, how can that divergence exist? The financial sources we have clearly show that income before taxes surged 58% year over year in FY 2025.
58%.
That's a massive leap in profitability. Why isn't the market rewarding that kind of efficiency right away?
Because the market is forward-looking.
Yeah.
And it's skeptical that divergence, fundamentals improving while the stock lags. It suggests this deep market ambivalence. It's what we call a show-me attitude.
A prove-it story.
Exactly. Investors want proof of two big things. First, that the long-term execution of that huge $60 billion CapEx plan is actually going to yield sustainable returns. And second, that the upcoming CEO succession is handled smoothly. They need to know that cost cuts weren't just a one-time gimmick.
That makes perfect sense. The market's waiting to see if this new financial structure works for, a few years, not just one fiscal year that was all about aggressive cost cutting. So the path forward is complex. What are the four critical pillars management is focused on right now heading into 2026?
Their entire strategy really rests on these four objectives. They're the company's North Star. First, they have to sustain that direct-to-consumer profitability now that they've finally achieved it.
Can't let it slip back into the red.
No way. It has to grow. Second, execute that aggressive, multi-decade, $60 billion capital expansion plan in the experiences division, the parks, resorts, and cruises. On time, on budget.
That $60 billion plan is just a huge number. We'll definitely have to dive into the specifics later. What about the media side of things?
So third, they face the challenge of successfully launching that standalone ESPN flagship service. It's their big play to get ahead of the secular decline of cable and the massive costs of sports rights.
And the last one?
Finally, and this one is maybe the most culturally critical, they have to stabilize the film studio's creative output after that. Well, that highly volatile, mixed bag performance we saw in 2023. Every single move Disney makes right now, from their strategy in Asia to who they hire, it all flows back to balancing these four objectives.
Okay, so to really understand the power and the position of Disney today, especially through that long-term investor lens, we have to look back. It all starts with the core flywheel, that Walt Disney himself designed.
Absolutely. The flywheel is the IP engine, and it's deceptively simple but incredibly powerful. It was really cemented with the opening of Disneyland back in 1955.
And how does it work, just for a quick refresher?
So films create that emotional connection. They create the intellectual property. That IP then drives park attendance because, people want to physically step into the world of the film.
And then once you're there,
That physical presence in the parks drives high-margin merchandise sales. That model, films, parks, products, it's still the core of the company's strategy today. The only difference is that now the films also drive high ARPU streaming subscriptions.
it's just fascinating how that model has survived a century of technological disruption. But the sources do remind us that the company's early history was, well, it was defined by high-risk innovation and a lot of vulnerability.
Oh, absolutely. We tend to romanticize the early days, but the company was constantly facing, existential threats. They released Snow White in 1937. That was a monumental financial gamble, the first ever feature-length animated film. If it had failed, the company might have just collapsed.
And they were vulnerable to other things too, right? Like labor issues?
For sure. The 1941 animator strike exposed a lot of internal tension, and then during the war, they had to shift production to low-margin, wartime propaganda films in the 1940s. It was a very constrained environment.
So innovation was really about survival, not just growth. The real strategic shift, though, that seems to have happened decades later with Michael Eisner.
The Eisner era, from 1984 to 2005, is just crucial because it built the machine that funded the next 2 decades of growth. And the strategic high point there was the $19 billion acquisition of Capital Cities ABC in 1995.
That's what turned them into a media titan.
It did. It transformed Disney from just a successful content creator into a broadcast powerhouse. And crucially, it cemented their majority ownership of ESPN.
And that gave them what everyone now calls the river of cash.
Exactly. For the next 20 years, linear television provided this massive, reliable dual revenue stream. You had affiliate fees from cable companies, which were basically risk-free tolls to carry ESPN, and then massive high-margin advertising revenue.
And that river of cash funded everything else.
It funded the park expansions, and, critically, it provided the capital for Bob Iger's aggressive IP acquisitions in the 2000s. The current decline in that linear business, which was still falling about 7% domestically in the last quarter of FY 2025, that's the direct unwinding of that decades-old model.
Which brings us perfectly to Bob Iger's first tenure, the IP acquisition era. I mean, when you look back at those deals now, they just look like textbook, brilliant capital deployment.
They're the benchmark for M&A, really.
Yeah.
Take Pixar in 2006 for $7.4 billion. That move wasn't just about getting more content. It saved Disney Animation from creative stagnation.
And it established a new model for acquisitions, didn't it?
It did. It established this crucial model of acquiring a creative culture and then letting it thrive on its own, instead of, smothering it with corporate bureaucracy, a masterstroke of integration.
But the financial home runs, the ones that really define the moat today, have to be Marvel and Lucasfilm. The returns there are just staggering.
Staggering is the right word. The $4 billion purchase of Marvel in 2009 is probably one of their most efficient uses of capital in recent corporate history.
What are the numbers on that?
By 2024, the sources confirmed the Marvel Cinematic Universe alone had generated over $13.2 billion in value. That's more than 3 times the purchase price. And that number doesn't even include park revenue, consumer products, or streaming value.
Wow. And Lucasfilm?
A similar story. Acquired for $4 billion in 2012, it brought in Star Wars. By 2024, it had generated nearly $12 billion in profit, a 2.9 times return fueled by the sequel trilogy and streaming hits like The Mandalorian.
So those numbers really confirm that Iger was a genius at identifying these irreplaceable, multi-generational IP assets. But then came the last and just enormous piece of the puzzle, Fox.
The $71.3 billion acquisition of 21st Century Fox in 2019 was, well, it was massive and incredibly complex. Strategically, you can argue it was necessary.
Why necessary?
It gave them control of Hulu. It gave them the scale and the content library like Avatar and The Simpsons that they needed to launch Disney Plus as a real global contender.
Yeah.
But it also saddled the company with massive debt and a portfolio with declining linear assets, which has required years of painful restructuring.
So if the Iger era was about strategic acquisition and mode expansion, basically buying assets, the Iger-Safekin era, where we are now, is about optimization.
Precisely. The sources all indicate the company is now in a comprehensive optimization and monetization phase. The focus is just laser-like on paying down that Fox debt, improving margins, and extracting maximum value from these huge past investments rather than going out and chasing new mega deals.
So it's a huge shift from being a content accumulator to being a high-efficiency content monetizer.
That's it, exactly.
That gives us the context. So now let's see what that optimization actually looks like on the balance sheet. Now we get to the numbers that really prove this restructuring is working. The financial results for fiscal year 2025, I mean, they demonstrate a company that successfully turned around its entire operating model.
The big picture metrics are pretty stunning because they just show pure operating leverage. So Disney reported total revenues of $94.4 billion for FY 2025. That was a modest 3% increase year over year.
Just 3%.
Yeah, that low single-digit growth reflects these competing dynamics. You have robust growth in parks and streaming, but it's being partially offset by that structural decline in linear TV.
But as we mentioned earlier, the real story is below the revenue line. 3% revenue growth yielding 58% profit growth is just phenomenal.
It's the signature of efficiency. Income before income taxes surged to $12 billion. That's a massive leap from the prior year's $7.6 billion.
Right.
And this is achieved through aggressive restructuring and, critically, over $7.5 billion in annualized sustainable cost savings.
$7.5 billion.
Realized across the entire company, from content production to marketing and corporate overhead. They are running the company dramatically leaner.
Wait, let's just pause on those cuts for a second. A $7.5 billion reduction is huge. Where specifically did the largest cuts come from? Was it mostly content or staff or overhead? And what's the long-term risk of taking a chainsaw to costs like that?
So the majority of the savings, we're talking nearly $4 billion, came from what they call content rationalization.
Meaning fewer shows.
Fewer productions,
Yeah.
and a much sharper focus on high-impact IP-like sequels rather than just filler content for Disney plus AZ.
Yeah.
The rest was achieved through massive layoffs, shedding over 8,000 roles, and consolidating corporate real estate and overhead.
And the risk?
The long-term risk is twofold. You could have creative burnout if the remaining teams are stretched too thin, and there's the risk of content quality decline if they prioritize efficiency over finding, the next Frozen.
That makes that show-me attitude from the market very understandable. Investors want to be sure those cuts haven't damaged the golden goose, which is the quality of the IP. But if we put that risk aside for a moment, the restoration of free cash flow or owner earnings, that's the clearest signal of financial health for a value investor.
Free cash flow restoration is the true bellwether here. FCF grew approximately 75% to hit $8.6 billion in FY 2025. This is the cash generated by the business after all necessary capital expenditures are paid for.
So that signals the end of the big spending phase.
It signals that the peak cash-burning investment phase for the streaming build-out has finally passed, and the company is once again generating substantial excess cash.
But the sources also have a crucial nuance about that FCF number. Doesn't a temporary tax deferral kind of artificially boost that $8.6 billion figure? We should be clear about the actual sustainable run rate.
That is a critical piece of detail. The FY 2025 FCF was boosted by a temporary $1.7 billion tax deferral, which was due to some timing adjustments on content amortization rules.
So what's the real number?
If we adjust for that one-time benefit, the sustainable underlying FCF run rate is probably closer to $6.9 to $8.4 billion annually. But even at the low end of that range, it is a monumental improvement from the capital burn they had during the streaming investment phase. Cash conversion is fundamentally strong again.
So let's look at the segment performance. Where is this cash actually being generated today?
This is where Disney's unique diversification really provides resilience. The experiences, segment parks, cruise line, consumer products, it remains the unchallenged financial fortress. It delivered a record full-year operating income of $10 billion in FY 2025.
$10 billion from just that one segment.
And that growth is so valuable because it's stable and predictable. It's fueled by industry-leading operating margins and just extremely high per capita guest spending at the domestic parks.
So parks are the stable, high-margin engine, which lets the rest of the company, the media side, transition without, an existential threat. What about the entertainment side, which is where the turnaround story is?
The entertainment segment operating income rose 19% to $4.7 billion. And this rise is attributed almost equally to two things. A rebound in theatrical releases, especially the core franchises like Inside Out 2 and Deadpool and Wolverine, and most critically, that pivot to profitability in streaming.
So streaming is now a modest contributor, not a major cash drain.
Exactly.
And what about the biggest structural threat to profitability, the sports segment? ESPN has been the source of so much anxiety because of that relentless cord-cutting trend.
ESPN remains the stabilizer. Despite the headwinds of cable decline, the sports segment was remarkably stable. It generated $911 million in Q4 operating income, and this stability is achieved by increasing affiliate fees.
So they're getting higher prices from fewer subscribers.
They're extracting higher prices from a shrinking base of cable subscribers,
Yeah.
And they have resilient advertising strength. They're managing to offset that steady trickle of subscriber losses for now, and that stability gives them the breathing room they need for the ESPN streaming pivot, which we should definitely talk about.
Excellent. So now that FCF is restored, how is management using that cash? The dividend was suspended during the crisis. Is management focused on debt, reinvestment, or shareholder returns?
Management has shifted toward a balanced capital allocation pivot, really focused on shareholder returns. For FY 2025, Disney targeted $3 billion in stock repurchases. And they have concrete plans to significantly increase that, potentially doubling it to $7 billion for FY 2026.
That's a very strong signal of confidence from management that the stock is undervalued.
It is.
But is that really the best use of $7 billion? I mean, isn't it just a short-term boost that leaves their substantial debt untouched? Is that really prudent, especially with a $60 billion CapEx plan looming?
That is the critical debate. Disney's balance sheet still carries a lot of debt from the Fox acquisition, over $35 billion in net debt. However, management is clearly weighing the value proposition. When a company believes its stock is trading below its intrinsic value, a buyback is the most efficient way to create value for shareholders.
So they're comfortable with the debt levels.
Given the stability of the park's cash flow, they are comfortable maintaining those debt levels while aggressively reducing the share count. They view their own stock as the best investment available right now. And the board is also tracking earnings to resume dividend growth, with a 75-cent per share payment planned for early calendar 2026.
So that puts the total dividend payment back at around $2.8 billion a year.
Right.
So we have a company generating $8 to $10 billion in owner earnings, committing about 25 to 30% of that to dividends, and dedicating another $7 billion to buybacks. That aggressive buyback plan really accelerates per share value growth, if the stock is, in fact, undervalued.
It does. It's a huge accelerant.
Okay, now we apply the ultimate filter. We've established the financials are recovering. But does the business possess that durable competitive advantage, the moat that makes it a wonderful company? Let's start with gate one, business simplicity and predictability.
Disney clears this gate easily. The core business is remarkably simple to understand, even if the corporate structure itself is complex. At the end of the day, Disney makes money by creating and selling magical entertainment. They monetize popular multi-generational content across multiple platforms.
Parks, streaming, merchandise, they charge for the enjoyment of their stories.
That's it.
It passes the simplicity test. But what about the 10-year test? Can we really predict what Disney will look like in 2035?
I think we can be highly confident in the core engine. Content formats will change, cable TV is disappearing, maybe AI-generated content rises. But the demand for Disney's specific multi-generational franchises, Star Wars, Marvel, the classic princesses, Pixar, that demand persists.
The fundamental economic engine is intact.
Exactly. Consumers will still be consuming Disney stories and vacationing at Disney parks a decade from now. This timeless IP provides exceptional resilience against technological obsolescence, and it makes the business highly predictable. The risk isn't being disrupted by tech. It's about managing the shift in distribution, which they are doing.
Check. Gate 1, pass. Let's move to the most important gate for any value investor, gate 2, the moat test, or durable competitive advantage.
This is Disney's crown jewel. It's the reason institutional investors view it as a cornerstone holding. Their moat isn't just wide, it's arguably one of the widest moats in the entire world. And it's anchored by their intangible assets, brand and IP.
That emotional connection.
Few, if any, companies in history have such an intense emotional and early connection with consumers. It starts in childhood and it continues across generations. And that emotional bond creates powerful pricing power.
So give us the tangible evidence of that pricing power. How do we know customers aren't just switching to a cheaper alternative when they see prices rise?
We know through two financial metrics. First, their high gross margins, which were around 37.8% in FY 2025. That reflects premium pricing across the board. Second, look at the experiences segment. That's the ultimate barometer.
Okay.
Disney has repeatedly and aggressively raised park ticket prices over the last decade, often way above the rate of inflation, without destroying demand.
I find that fascinating. I mean, what other company can you name where you're willing to pay a premium just to stand on the physical land that the company created? That's a powerful psychological moat.
Exactly. They increased domestic park per capita guest spending by double-digit percentages compared to pre-pandemic levels, even as attendance normalized. They successfully implemented variable pricing, the reservation system, Genie Plus Now, all designed to extract maximum value.
So people pay a massive premium just because it's Disney.
Right. You can't substitute the Disney magic with a trip to a regional amusement park.
Yeah.
That inelastic demand is the very definition of a moat.
So the magic is basically a toll booth, and once you're inside the ecosystem, the lock-in effect takes over and just reinforces itself.
That's the third component of the moat, customer lock-in and the ecosystem. The flywheel reinforces itself continuously. You watch a new Marvel project on Disney Plus Cap, which inspires you to buy the merchandise, which inspires you to book a trip to the new Tropical America's land at Animal Kingdom.
Competitors can't replicate that.
They can't. That end-to-end vertically integrated experience is unique. Netflix only has content. Comcast Universal only has parks. Disney offers the whole lifestyle.
And finally, the sheer scale of the operation provides cost advantages that no competitor can touch. That's a structural benefit.
A massive, quantifiable advantage. Disney amortizes the cost of a blockbuster, say, the upcoming Avatar. Fire and ash across multiple distinct revenue streams. Theatrical, streaming, park attractions, consumer products. They extract value from that one asset at a far lower unit cost than rivals who might only have one or two channels.
So in essence, they make one piece of content and then harvest revenue from 7 different departments.
That's it. This scale advantage, combined with their huge installed base of high-margin parks and cruise ships, gives them economies of scale that competitors just struggle to match. The fact that the park segment hit a record $10 billion in operating profit proves those economies are working. So, gate 2.
Moat pass. Definitely. On to gate 3, management quality and capital allocation. We talked about the strategic genius of Iger's acquisitions, Pixar, Marvel, Lucasfilm as classic moat-widening moves. What about his more recent Iger II track record?
Well, Iger is widely respected for his strategic vision, but his return has been marked by a necessary return to, owner-oriented decisions. Crucially, suspending the dividend during the pandemic to conserve cash. That was a financially prudent long-term move that stabilized the balance sheet when the parks were shut down.
That decision showed they valued the health of the company over short-term dividend payments, which is a hallmark of owner management.
Precisely. And now, with FCF strong again, they're resuming capital returns, the dividends and the $7 billion in targeted buybacks, which shows a commitment to balancing reinvestment with returning cash to owners. They've also showed discipline in restructuring and shedding parts of the complex Fox linear assets.
The internal investments they are making, the $60 billion park plan, the Disney Plus build-out, have those historically yielded good returns? Are we confident in the future CapEx?
The history is strong. The acquisitions were a success. The internal reinvestments, like building Star Wars, Galaxy's Edge successfully widened the moat and drove premium attendance and spending. These moves position the company to now harvest cash flow from those highly durable assets. The market's skepticism is really just focused on whether the current management team can repeat that success with the next $60 billion.
So management clears the bar. They have a history of value-accretive moves. They were prudent during the crisis, and now they're disciplined about buybacks because they see the stock is undervalued.
Correct. The culture emphasizes quality and brand protection, which is why the IP remains so valuable. And the commitment to achieving and sustaining profitability in streaming shows they aren't just chasing growth for growth's sake anymore. They're focused on return on invested capital. Gate 3. Pass. The Walt Disney Company comfortably passes all 3 qualitative Buffett gates. It's a wonderful business.
Okay, let's dive into the core battleground for future growth, the direct-to-consumer streaming business. We mentioned it briefly, but FY 2025 marked a massive, really difficult-to-achieve turning point here.
It was a massive strategic victory and a non-negotiable prerequisite for the stock's turnaround. FY 2025 marked the achievement of a full-year profitability milestone for the combined streaming segment, Disney Plus Hulu and ESPN Plus Colby.
That's a huge psychological and financial reversal.
It is. In Q4 FY 2025 alone, the combined streaming businesses generated $321 million in operating income. Just compare that to the quarterly losses of over $1 billion reported just 2 years prior.
So, the streaming wars are shifting from a land grab to a focus on margin. How robust is this profitability, and what are the quality metrics for the subscriber base?
The scale is now truly global, with a total footprint over 153 million subscribers. More critically, Disney is mastering monetization. The average revenue per user, or ARPU, for domestic Disney Plus rose to $7.99 in early FY 2025.
And that shows they successfully executed their pricing strategy.
It shows they successfully raised the base price and, crucially, migrated cost-sensitive users to the higher-margin ad-supported tier. They're just monetizing their users better than ever.
However, the sources do point out one clear, lingering challenge here, and that's churn. We know Netflix is the benchmark because their service is seen as essential.
That's right. Netflix is viewed as a utility, a continuous viewing habit. Their monthly churn is closer to 2%. Disney Plus churn is significantly higher at about 4.8%, and Hulu is 5.8%.
And that data suggests Disney Plus is often seen as a discretionary add-on.
Exactly. People subscribe for the latest Star Wars series, binge the content, and then cancel. This makes the overall cost of customer acquisition much higher.
So what's the definitive solution to move Disney Plus from a discretionary add-on to a utility? How do they force customers to stay?
The Disney Bundle is the only proven strategy right now. Internal data shows that subscribers who take the Disney Bundle, Disney Plus Hulu, ESPN Plus, Tane, they exhibit significantly lower churn rates, often approaching Netflix's retention levels.
Because they feel they're getting more value.
So much more value for their money. And the company aggressively integrated Hulu content directly into the Disney Plus app interface in 2024. That wasn't an accident. It was a deliberate UI decision designed specifically to increase time spent on the platform, which is the primary predictor of retention.
Now we move to the toughest media asset to transition, ESPN. This is the structural challenge that still has the potential to overshadow all the other positive changes.
It does. The old cable cash cow is dissolving, and the cost of sports rights is only going up.
So what's the plan?
The launch of the standalone ESPN flagship streaming service, branded ESPN Unlimited, in August 2025, is Disney's definitive answer to the post-cable world. This launch ensures that the undisputed king of U.S. sports rights can still reach superfans, regardless of the declining cable pipe. The stakes could not be higher.
What's the price point on that, and how aggressive is the adoption strategy? They need scale immediately.
The standalone service is priced aggressively at $29.99 per month, but the actual strategy is the bundle. Disney is offering the entire Disney Bundle, Disney Plus, Hulu, and ESPN Unlimited, all ad-supported for the same price, $29.99 a month for the first year.
Wow. So they're basically giving away the entertainment apps for free.
It's a brilliant, immediate land-grab maneuver. It's designed to establish a loyal subscriber base among sports superfans by giving them everything, which directly addresses that retention challenge we just discussed.
That strategy clearly makes the ESPN product the anchor, securing those high-value sports subscribers who will hopefully stick around for the entertainment. But there was a major antitrust setback recently that could complicate things.
That's the Venue Sports issue. So Disney, along with Fox and Warner Bros. Discovery, they tried to launch Venue Sports, which would have been a combined sports streaming product. But a federal judge granted a preliminary injunction in late 2025, blocking the launch after a lawsuit by Fubo TV.
And what was the exact legal reasoning the judge cited for blocking that partnership?
The court found that the joint venture, which would have aggregated the rights for roughly 55% of all live sports in the U.S., would control a monopolistic share of those rights. Fubo TV argued this would suppress competition, and the ruling essentially prevents Disney from sharing the risk and costs of the digital transition with its primary competitors.
So what's the implication of that?
It's substantial. It places even greater strategic weight on their own proprietary ESPN flagship service. Disney can't rely on its competitors to share the cost or the risk anymore. They have to succeed purely with ESPN Unlimited. It was a clear warning shot from regulators about aggregating too many sports rights.
Finally, in global operations, Disney executed a major asset-light pivot in India. What was the rationale there?
The Indian market, specifically the Hotstar streaming service, became a severe drag on profitability after Disney lost the invaluable IPL cricket rights in 2023. That led to rapid subscriber erosion. So rather than engaging in a destructive price war in a low ARPU market, Disney merged its Star India assets with Reliance's Viacom18.
And what's the strategic benefit of that joint venture structure?
The deal structurally benefits Disney immensely. The JV is valued at around $8.5 billion. Reliance controls the majority, but Disney retains a significant 36.84% equity stake. The key here is that it deconsolidates the highly volatile Indian ad market, removes that risk from Disney's income statement while still giving them equity upside in a dominant local entity.
So it's a smart move to trade high volatility for stability and focus capital allocation somewhere else.
Exactly, primarily in the domestic parks and core content.
Okay, let's shift our focus to the experiences segment, that financial fortress that generated $10 billion in operating income in FY 2025. This segment is where Disney is deploying the vast majority of its capital for the next decade, that $60 billion capex plan.
The commitment here is not just large, it's an absolute necessity for long-term moat fortification. That $60 billion plan over the next decade is designed to expand capacity globally, ensuring demand can keep up with supply and to integrate cutting-edge new IP into the physical space to entice repeat visits.
Without expansion, they risk capping their primary cash engine.
They do.
What are the key projects they're prioritizing in Walt Disney World, and what's the strategic timing behind them?
The expansion is highly targeted and aggressively scheduled. The Magic Kingdom is getting a major expansion with Villains Land, the project beyond Big Thunder Mountain, projected to open around 2029-2030. This is strategically important because it targets a key demographic, gap teens and young adults, with edgier experiences.
So they're ensuring the parks evolve with their audience.
Right. And what about Animal Kingdom? That park has historically been seen as needing the most attention to increase its full-day capacity.
For sure.
The Tropical Americas project is perhaps the most competitively aggressive move in the whole CapEx plan. It's replacing the aging Dinoland USA with lands featuring highly popular IP like Encanto and Indiana Jones.
And the timing on that?
Groundbreaking happened early in 2025, and the targeted opening date is aggressively set for 2027. That timeline is specifically designed to revitalize Animal Kingdom before the competing Universal's Epic Universe Park opens nearby. This is a defensive, competitive capital deployment to maintain market share dominance in Orlando.
Beyond the theme parks, Disney is also rapidly expanding its cruise line fleet, which is a high-margin, high-demand segment.
The cruise line is adding nearly 50% capacity with the launch of the Disney Treasure and Disney Destiny. And crucially, they are also pursuing strategic Asian expansion with the Disney Adventure home-ported in Singapore.
Which is a very asset-light way to get into a new market.
It's an asset-light way to enter a massive, high-growth Southeast Asian vacation market without the regulatory complexity and enormous capital outlay of building a new theme park. A very shrewd use of capital.
We're also seeing Disney push the boundaries of technology to future-proof the physical park experience. Tell us about the holotile floor. It sounds like something straight out of science fiction.
The holotile floor, invented by Lanny Smoot, is genuinely groundbreaking technology. It's an omnidirectional treadmill that lets multiple users walk in any direction in a shared virtual space without leaving the platform or colliding.
Wow. And the application.
The potential application is for next-generation holodeck-style attractions, where guests could physically explore virtual environments like the surface of Tatooine or the grid from Tron without needing bulky headsets. This could let Disney lead the location-based VR market.
And that brings us to their digital moat expansion, the $1.5 billion investment in Epic Games. This is all about capturing the next generation.
That investment is one of the clearest signals of the future of the Disney flywheel. The investment aims to create a persistent Disney universe connected to Fortnite. The goal is explicit. Capture the Gen Alpha demographic where they already spend their time.
A digital Disneyland.
Essentially. By late 2025, we saw the first fruits of this with Disneyland Game Rush appearing within Fortnite. It's a massive play to ensure the next generation develops that same emotional connection to the brand.
Finally, let's talk about the studio content strategy, which is the necessary spark for this entire ecosystem. Following that difficult 2023, what does the forward slate look like, and what are the primary risks?
Well, the studio rebounded strongly in 2024 and 2025, led by hits like Inside Out 2 and Deadpool and Wolverine, which validated the integration of those R-rated Fox assets. However, the forward slate for 2025 and 2026 is overwhelmingly sequel-driven.
We're talking proven IP.
We're looking at guaranteed reliance on proven IP, Zootopia 2, Avatar, Fire and Ash, Toy Story 5, The Mandalorian Grogu, and Avengers.
Doomsday. That is a staggering reliance on established IP, but isn't relying entirely on sequels fundamentally riskier than creating new IP? Aren't they mortgaging the creative future to boost near-term cash flow?
That is the $24 billion content budget question. Analysts have raised significant concerns about franchise fatigue. The market's rejection of mediocre franchise entries in 2023 was a strong signal that audiences will not pay for low-quality output, even if it has a famous name.
So the pressure is on for these sequels to be good?
The success of this upcoming sequel-heavy slate is absolutely critical. If Toy Story 5 underperforms, it suggests a deeper, systemic problem. That $24 billion budget needs to produce guaranteed hits, not just reliable filler. The focus on sequels is a calculated financial decision, but it maximizes the risk of creative stagnation.
So management is prioritizing FCF generation today, but they have to make sure they don't hollow out the creative culture that generates the next round of IP.
Or the moat will eventually dry up.
Okay, the business fundamentals are sound, the strategies are clear, but for a long-term investor, stability at the top is paramount. Disney has recently been a corporate battleground, defined by a major proxy fight and the looming question of CEO succession.
The early 2024 proxy battle with activist investor Nelson Peltz was significant because it really defined the political landscape for this Iger II era. Disney won by a substantial margin, re-electing their full slate of nominees.
And that victory gave Iger the capital to execute his plan.
It secured him the political capital necessary to execute this aggressive, multi-year restructuring plan without fear of activist interference or short-term demands. A key defensive victory that gave him 2 years of certainty.
And we can't overlook the political risk that was hanging over the experiences segment, the whole confrontation with Florida Governor DeSantis.
The Florida Teton was another non-negotiable prerequisite for that $60 billion CapEx plan. After the state took over the special district, Disney and the state reached a settlement in March 2024.
And what was the deal there?
Disney essentially traded its public political voice for the regulatory certainty it needed to proceed with that massive investment. Without that resolution, the park's expansion would have been stalled for years, severely handicapping their most profitable segment.
So stability is returning, but the most important strategic question remains. Who succeeds Bob Iger when his contract expires on December 31st, 2026? This determines the long-term culture and capital allocation strategy.
The board has signaled a rigorous, disciplined process this time, learning from the previous, let's say, haphazard succession. In October 2024, James P. Gorman, the executive chairman of Morgan Stanley and a widely respected succession specialist, was named the new board chairman. That signals discipline.
Who is currently leading the internal candidate list, and what are their specific strengths?
So Josh D'Amaro, the chairman of Disney Experiences, is generally considered the leading frontrunner. His primary strength is that he manages the most profitable division, that $10 billion cash engine, and he has demonstrated success in managing large-scale capital projects. He's the operator.
And the other contender?
Dana Walden, the co-chair of Disney Entertainment, provides the necessary creative depth and media expertise managing the studio and streaming content.
And the timeline.
The board plans to name the next CEO in early 2026, which allows for a lengthy 10-month transition period before Iger departs. This is a highly prudent step designed to stabilize the organization and reassure the market.
Let's bring it all back to value, tying the qualitative strengths to the quantitative cash flow recovery. We established that Disney comfortably passes the qualitative Buffett gates. But does the price make sense for a value investor today?
The valuation conclusion synthesizes everything we've discussed. We established that Disney's owner earnings capacity, adjusted for that tax deferral, has recovered to a sustainable $8 to $10 billion annual free cash flow range. This is the critical baseline for long-term valuation. And if you're tracking the overall market temperature, you might find it useful to check the Buffett Indicator iOS app. It's a great tool for monitoring market frothiness. But based on our deep dive here.
Absolutely. If you're curious about deep value principles in broader markets, search and download the Buffett Indicator iOS app from the Apple App Store for daily updates. But back to Disney. If we look at the reverse DCF analysis, what the market is currently implying at the late 2025 price of around $113 a share, what growth rate are investors actually expecting?
This is the key insight. If an investor requires a 10% return on capital, the current price of $113 is pricing in roughly 4.9% long-term FCF growth.
So the market is expecting moderate, decent growth.
Not spectacular. Exponential growth, like a tech company that might require 15 to 20% implied growth. The bar for success is therefore highly achievable for a company with Disney's pricing power.
So contrast that with the intrinsic value scenarios we can model.
We can establish a floor and a base case. A conservative, no-growth scenario, assuming 10 billion FCF, 10% discount, zero growth forever, would yield an intrinsic value of about $55 per share.
The fact that the stock is double that clearly shows the market expects growth.
Right. Our base case scenario, assuming management executes on the park expansion and streaming profitability and achieves 6% FCF growth, just 1.1% more than the market implies, that yields an intrinsic value of approximately $146 per share.
So if we assume 6% growth, that means by 2035, Disney's FCF would be $17.9 billion. Does that seem plausible based on the $60 billion CapEx plan and the streaming pivot?
It seems highly plausible, maybe even conservative. That $16 billion in CapEx is specifically designed to expand the most profitable segment and is expected to yield mid to high single-digit returns. Just the successful execution of the Animal Kingdom expansion and the cruise line additions should be enough to justify that 6% annual growth. Because Disney has such a durable moat and pricing power, its future cash flows are just far more certain than those of most other media companies.
So the final investment verdict.
Disney is not a deep bargain. It's not trading at $55, but it is trading on the low end of its estimated intrinsic value range of, say, $120 to $140. It's a wonderful company at a fair price. The price offers substantial upside if management executes on that 6+% growth implied by the park expansions and streaming margin improvement.
And the buyback helps.
And that large, planned $7 billion share buyback in FY 2026 is a savvy move that accelerates per-share value growth while the stock is modestly undervalued. For long-term holder focused on quality and cash flow, this is a very strong foundation.
That brings us to the summary of our deep dive. Disney has successfully pivoted from debt-laden, streaming-first growth to strict profitability, a transition that fundamentally required those painful $7.5 billion in cost cuts. The $10 billion experiences segment is the stable cash fortress that funds everything else, and it's now positioned for a decade of capacity expansion.
And the biggest remaining challenges are clearly defined. That complex digital transition, specifically the successful launch and scale of the proprietary ESPN flagship service after the antitrust setback, and maintaining creative momentum in that highly sequel-heavy film slate. The company is demonstrably leaner, more focused, making it structurally resilient against the decline of linear TV.
So for you, the learner, you now have the full context for Disney's transformation. You know where the cash comes from, what the growth engines are, and what risks remain. The recovery is absolutely real, and the moat is as wide as ever.
As we conclude, let's just leave you with the final, provocative thought that really defines Disney's long-term future. Disney's historical moat relies entirely on the uniqueness of its content. As we detailed, the entire content slate is shifting toward established, sequel-heavy IP Toy Story 5, the Moana live-action remake, Avengers, Doomsday.
Yeah.
This reliance on nostalgia is being monetized like never before. They're essentially harvesting the value created by previous leadership teams.
So the final question for the next leadership team, the one they'll name in early 2026, is not just how much money they can make from the existing IP through sequels and park additions. The crucial question is whether they have left enough room in that $24 billion content budget, and whether they've maintained a supportive creative culture to create the next Marvel or the next Frozen.
The original, high-risk, high-return content that is necessary to ensure the moat is fortified for the following century. That ability to innovate, not just iterate, will be the ultimate measure of the next CEO's long-term success.
And just a quick disclaimer for everyone listening. All the analysis in this deep dive is based on publicly available sources and may be subject to revisions or different interpretations. This content is for educational purposes only and does not constitute investment advice.
Please always conduct your own due diligence before making any investment decisions. And if you'd like to listen to our full deep dive on this topic or access more advanced content, you can join our Deep Value Club membership or subscribe to us on Apple or Spotify podcasts at Deep Value Investing.